Hey, everybody, come on in and let me ask you a question. If you had to teach your kids just five things about trading chart patterns, what would those five things be? That's the question that Luther asked me, and that's what I'm going to share with you in this session. Let's go. All right, folks, welcome. I am Jeremy Whaley from Trade Maestro. It's great to be with you. And I was just sitting here getting ready for my group coaching session that we're going to be teaching tomorrow night or tonight, depending on when you're watching this. And I was reminded of our last session about a week ago. Luther asked a great question. He asked me, he said, Jeremy, if you had to teach kids 5 or 6 chart patterns, what would they be? And of course, my kids are little. They're like 11 and 9, and so little kids. And I thought about it a minute, and I said, Luther, it's a great question. It's just the wrong question. And so I put together, actually right then, I answered the question and kind of came up with this outline. And it was pretty good. So I thought I'd share it with you. And, if it's useful for you, then great. If not, then, let it go. But here we go. Top 5 things I would teach my kids about chart patterns. That's what we're going to talk about. And the first one actually is not a pattern. The first one is the principle that patterns exist. If you want to understand how trading chart patterns work, if you really want to understand the stock market, if you want to get an edge, you need to understand this very basic principle that patterns actually exist. So let me show you what I'm talking about. See if we can get my screen to come up here. There we go. So just take a look over here at this chart. This is the Dow Jones Industrial Average. It doesn't really matter what we're looking at, but just take a look here and you'll notice, I'm going to highlight this in yellow. You see how all of this price action stops. It stops up here at the top. It stops down here at the bottom. For those of you who know patterns, you might say, oh, that looks like a channel. And it kind of does look like a channel, but it doesn't matter what the pattern is called. The pattern is really irrelevant. What matters is the reality that for whatever reason, the people that are trading this, in this case, it's an index, they get up here to about this price point and it turns down. They get down here about this price point and it turns up. They get up here to this price point and it turns down. And you could box it in. It's stuck right there. That, folks, is a pattern. That's what I'm talking about. Just recognizing that patterns exist is really important and in and of itself is very practical. So you can look at any chart. Every chart you look at is going to have patterns available and they're just there. They're there all the time. Let's look at a few more on this chart here. If I go back in time just a little bit here, you can see there was a little pattern right here. There's a little pattern right here. There's actually a little pattern right over here. I can go back in time even further, which I'm going to do. And you notice I'm not even naming these patterns. Doesn't matter what the name is. There's a pattern right in there. There's a pattern right in here. There's a pattern right in here. Okay. These patterns represent a congestion, if you will. It's a congestion of trading behavior. And what you're going to find with every trade, it doesn't matter if you're trading stock, if you're trading options, futures, forex, cryptocurrencies, it doesn't matter what you're trading. When you see a chart, you're going to see the price action get stuck. And every pattern, whatever the classification is always going to be ultimately a result of the same thing, and that is what we call consolidation. The price action's consolidating. And so it's really important to understand that patterns do exist, and the reason it's important to understand is because of the second principle, which is this: breakouts from any pattern generally lead to a big move. So if I could teach my kids just 5 things about trading chart patterns, the first thing is recognize that patterns exist. Learn to recognize those congested behaviors and then know that that is an opportunity, because when you see all those candlesticks getting congested, you see all that price action getting stuck there, there's going to be a breakout. And when it breaks out, whichever way it breaks out, doesn't matter if you know the name of the pattern, doesn't matter if it's a reversal pattern or a continuation pattern or whatever, whenever it breaks out, whichever way, it generally leads to a big move. So let me show you what I'm talking about here. Let's come over here back to the same chart that we were looking at. And you'll notice that there was some congestion right in here where I'm drawing the yellow box. What happened when it broke out? Boom, it's off and running. It's running to the race. I'm going to, just kind of mark in here another little section. What happens when it breaks out? Boom, it's off and running. There's another little congestion in here. What happens? Boom, it's off and running. These are actually continuation patterns right here. But then we get up here to the top. What happens? Start to congest again. It's not going anywhere. And then when it finally breaks out, boom, we're off to the races. Folks, that's how chart patterns work. Chart patterns, regardless of the pattern, regardless of the name of it, what it does is it is simply a congestion of price action, price behavior. It gets all stuck together. So I don't care if you know the name of the pattern. That's what I would tell my kids. I don't care if you call it the right thing. Just know what it does and know what it means. And what it means is this: when the price action breaks out of that pattern, it's generally going to lead to a big move. So that's the second principle. The third principle that I would teach my kids, if I had to teach them just 5 or 6 things about chart patterns, the third principle I would teach them is this: the principle of double tops and reversals. Now, double tops are actually a pattern, okay? It's a specific type of pattern. If we were to come back over here to our chart, let's see, I think there was one back, where is it? Let's go back in time. There it is. I knew we had one in here. Let me try to make it a little bit bigger for you here. See if we can zoom in. I'm not sure how big the screen is that you're watching this. You can go full screen if you're looking on a small, tiny computer. So notice up here, as this particular trade, this was a huge bull trend that we had. This thing's been in a bullish trend forever, right? Had some consolidations back there, but we get up here, we put in a higher high. This is the circle I just drew. That's your first peak. Now, here's what happens with a double top. We put in a higher high, it pulls back. Okay, that's natural. That's normal. We would expect that. It goes higher or very close to the same high, puts in another similar high. Okay, that's not a problem. And then it comes back down, and I'm going to change my pen color here just for emphasis here. You see where I'm drawing it in blue. See that? We call that, there's a technical term for that, we call that the neckline. Okay? Now here's the principle. When the chart that you're trading puts in a double top like this and it drops below the neckline, especially a close below the neckline. When it drops below the neckline, that is a confirmation of a trend reversal. Whoa. Okay, so it doesn't matter if you know what to call the pattern, just recognize it here. We're putting in this double top type of a pattern. We break below the neckline. That is what we call trend reversal. Now, if you can get early on into a trend, you're going to be able to make a lot of money, right? Whether it's a bullish trend or a bearish trend. And that's what I would teach my kids about patterns. Number one, they exist. Number two, the breakout of the pattern, usually followed by a big move. Then we're going to move into reversal patterns. We'll start with this double top, because if anybody, a 6-year-old or a 60-year-old, can understand this double top pattern and understand that when we break below that, it typically leads to a reversal. It is a reversal. It's a confirmation reversal. That's a new trend in the opposite direction. That's one of the most profitable trends you'll be able to get into. But here's why it's so powerful to learn this pattern, okay? I'm going to scoot this chart over just a little bit, because once you have learned the double top, how hard is it to recognize that? Well, first of all, before I move on, let me do it this way here before I move on here. There's 3 types of double top patterns. One is what I just kind of drew out here. It's what I call matching highs. Okay, it looks a little bit like that. It looks like an M. And the old joke is M for murder, because whenever you see a double top, the trade's about to get murdered. It's about to go down. Okay, there's another variation of it which has a higher high, but it still puts in an M for murder. And again, same principle. When it drops below the neckline, then that is a confirmation of the reversal. So I'll put the little neckline in there. Okay, and then here's the third variation. It's a lower high on the next one. Okay, so it's kind of leaning over. I call this a leaning top. Okay, and so those are the 3 variations of double tops. They all basically look the same, right? They're all M's. It's just, are they matching highs? Is the second peak a higher high, or is the second peak a lower high? That's the variation. Now, here's why it's so powerful. If a kid or an adult or anybody else can learn to trade the stock market, they can learn to recognize that first double top. How hard is it to recognize this pattern right here and say, oh, it's just 2 M's put together? 2 M's put together. The first one is the higher high. The second one is the kind of the falling peak, if you will, or the sloping peak, whatever you want to call it. Now watch this, folks. This also has the exact same neckline. Again, it doesn't matter if you know the name of this pattern. This pattern just so happens to be what we call a head and shoulders. Okay? Just so happens to be that it's a head and shoulders, but it doesn't matter if you know the name. You understand how it works because you learned the double top. And how hard is it to teach a kid, a 6-year-old, a 60-year-old, or any other age, to now evolve that into this pattern right here, which we call a triple top? It's the exact same thing. Or we could put it into one of these where we have a multi-top for 4 or 5 or 6 or however many you need to have in there. It doesn't matter, see? Because once they understand the double top, they understand the reversal. Once you understand the reversal, you know how to get ahead of the trend. And so it's that simple to start learning how to trade a trend, learning how to recognize the reversals at the key moments by simply understanding, number one, that the patterns exist. Number two, that when the patterns do break, regardless of which direction they break, it tends to lead to a big trend. And then the third principle here is learn to recognize those double tops, learn to recognize the variations of that, because that's a reversal. Now watch this. You ready? Once we've learned to recognize the double top, we can spread it into all the other tops there. Well, guess where else it shows up? It shows up at the bottom. Could we move that into a double bottom? And could we have 3 variations of the double bottom, which has a lower low, a matching low, and, oh, I didn't do it very good. We'll do this one a little more exaggerated. There we go. A little sloping low, okay, where it's already kind of moving up the hill. Now, you notice at the bottom, the double bottom here looks like a W for winner. And the old saying goes, when you see a double bottom, you see a W for winner, trade's about to go up. So you see, we're flipping that basic double top pattern. You flip it upside down, and now a kid can recognize not just the double top, but the double bottom is exactly the same thing, just inverted, and now they can recognize a trend reversal moving from a bearish trend going back around to a bullish trend. So you see how simple it really can be to start recognizing patterns and to start kind of pulling it all together. It's really not that hard at all. Okay, now the fourth principle that I would teach my kids. So number one, let's recap here. Number one, patterns exist. Number two, when a pattern breaks, tends to be a pretty good follow through with that. Number three, we're going to learn double tops and reversals. Number four, we're going to learn a principle that's actually not a chart pattern principle. This is actually a principle of technical analysis, but it goes like this. A trend in motion tends to stay in motion. A trend in motion tends to stay in motion, okay? Now, this is part of Dow theory, but it's very relevant to chart patterns because we've already laid the foundation for how chart patterns work. We've identified that they exist. We've identified that the breakout of the pattern is a big opportunity. We've identified reversals now, all with one pattern, just starting with a double top. Now we're going to go to the continuation patterns, which we're going to sum it up by saying a trend in motion tends to stay in motion. Now, most people can remember this because most people remember back to high school or even elementary school, whenever it was that you learned an object in motion tends to stay in motion. Remember that was from like science or something? Remember that? An object in motion tends to stay in motion. So if you're rolling an object, it tends to continue rolling. Eventually friction will slow it down, but you understand the principle there from basic science. Well, we can apply that to the stock market. A trend in motion tends to stay in motion. How does that apply to the chart pattern? Well, let's come over here to a trend. And let me zoom out just a little bit so we have them all up here. And let's just start with this pattern right here that we've identified a couple of times. This is a little bit of a consolidation pattern. Once it broke out, boom, patterns, trade's going, we're off and we're running. Now watch this. I'm going to highlight some areas in yellow, okay? The trade pulls back. Now, the trader who doesn't understand this principle, a trend in motion tends to stay in motion. The trader who doesn't understand that, right there where I just drew that and just putting the arrow right now, typically traders will bail. They'll freak out, they'll start selling, and they're getting out exactly at the wrong time. Because about the time they start jumping out, boom, the trade goes the other direction. Now, next thing that's going to happen, you're going to see it does it again. Then it does it again. And if we kept going, you'd see it keeps doing it again and again. Well, what's happening here? Every time I get into the trade, it turns around and goes down. I get out of the trade. Boom, it turns around and keeps going higher. I finally jump back into the trade. It turns, it goes back down against me. Why? How many traders do you think have that story in their head? And the answer is millions of traders around the world. They're failing to recognize this principle. A trend in motion, which I'm drawing some very rough trend lines right now, a trend in motion tends to stay in motion. What you're learning with that principle, with that philosophy, is that just because there's a pull down, which I'm now going to draw arrows in a different pen color here, just because there's a little drawdown or a pullback doesn't mean that the trend has reversed. Doesn't mean that. In fact, it's quite the opposite. These little pullbacks are resets with momentum. And there's a pattern that goes with this. This pattern, I don't care what you call it. I don't care if you call it the right thing or not. It's technically a flag pattern, or the variation is a pennant pattern or a stair step. These are what we call continuation patterns. Now, continuation patterns suggest that the trend is going to continue. And when you learn to recognize these patterns, well, it's really nice. It's like, oh, that's just a continuation pattern. Let's jump into the trend and let's continue on the little train here. We'll just keep making more money, right? That's the idea. But look, most people can't remember all the pattern names, and I'm fine with that. I don't care if you call it a flag or a stair step or a pennant or a World Series. I mean, I don't really care what you called the pattern as long as you recognize it. And understanding and remembering this little old saying, this adage, a trend in motion tends to stay in motion. Just remembering that will help you remember when you see that pullback right here, when you see that this thing is coming back, it's coming back to a trend line, you'll remember, oh, it takes a lot of energy to reverse a trend. It's like changing the direction of an object. It takes a lot of energy. You don't just reverse on a whim. It actually takes a lot of work. It's a lot easier to stay in the same direction of the trend. Then you start to recognize the bottoms in here, and you start to buy. It's what we call buy the dip. And so you become a buy the dipper, and you're buying the dips. And now you're getting in at much better opportunities in the trade, and you're becoming a much better trader simply because you learned the adage that a trend in motion tends to stay in motion. And in learning that, you also now set yourself up to recognize all of the trade or the trend continuation patterns. So here we are in basically 4 principles. We've really understood everything you need to understand about chart patterns, even if you never learn the names. The first principle is patterns exist. And we've learned with that, you know, patterns are nothing more than little moments of consolidation and price action. Then that leads us to principle number 2. When the pattern breaks out, it has an explosive move. There's going to be a trading opportunity on the breakout of the trend. Okay. Now, it doesn't matter if you know what the name of that pattern is. It doesn't matter at all. You can jump into it. Okay. Third principle is we learned the double top, which sets us up for all the reversal patterns. Fourth principle, we're going to learn that a trend in motion tends to stay in motion. That sets us up for all the continuation principles. Well, the problem is Luther asked me, what are the 5 things that I would teach? And I got it down to 4. So here's the 5th one. If there was a 5th principle tied to chart patterns that I would teach, it would be this. It would be the principle of gaps. And to teach this, I'm going to go back to the old Japanese saying. You see, in Japanese trading, they call a gap a window. Think about it like a window for your house. And the saying goes like this: trade in the direction of the open window. Trade in the direction of the open window. So if the window's open, well, that makes no sense. If the window's open to the upside, then you're going to trade bullish. If the window's open to the downside, you're going to trade bearish. Okay, trade in the direction of the open window. Let's come over here and look at a chart, and I'll show you what I'm talking about. Let's go back to right here. Okay. By the way, folks, this time period, you know, I drew out the double top. Right, drew out this double top. This was getting into the coronavirus. That big sell-off that you see right there, that was COVID season, baby. And that's when the whole world came to a grinding halt. People say, you know, technical analysis, how can it predict anything? Look, folks, I'm telling you right here, 2 weeks before we had the COVID crisis, what happened? We had a double top showed up in the Dow Jones Industrial Average. Okay, watch what else happened here. We had a gap. Okay, now let me zoom in on this so you can really see it, because this screen I'm monitoring on kind of makes it look like it's small. But what a gap is it's a space in price action. It's this area right here where there's no trades that take place, where I just drew this arrow, okay? Now, a gap, it can be the result of a lot of things. On an index, it can definitely be the result of a lot of things. But with a typical trade, typical stock, it's either going to be the result of a lot of buying pressure overnight or a lot of selling pressure. That's That's the bottom line. That's what it's going to be. So the morning comes, market makers there, and they're trying to make the market. And for whatever reason, they have a lot of selling orders or they have a lot of buying orders. And so they start raising the prices and lowering the prices to try to attract the opposite side of the order. That's what happens, okay? But forget the why. Just understand the pattern here. Here's what happens with the pattern. So you have this gap. This is what we would call a bearish gap. There is a technical term for this, specific gap. And we call that specific gap a breakaway gap. Now, if you were sitting here classifying all your breakaway gaps, what you need to know is breakaway gaps are the beginning of a new trend in the opposite direction. Great to know, right? Yeah, if you're looking at a double top and suddenly there's a breakaway gap in the opposite direction, probably a good sign to, in this case, short the market or buy some puts on the market, right? Yeah. Really, really good sign. That's the power of chart patterns right there. But forget that. Let's talk about the old Chinese, or the Japanese saying, trade in the direction of the open window. So in this case, the window is open to the downside. As long as, here's the principle, as long as the window is open, you're going to be bearish. So until that space fills, you're going to be bearish in this trade. Now, in practice, that's the old saying. In practice, you don't want to wait that long. We're going to go into a bearish trade and we'll get out later in the trend. I'll teach you some other stuff at another time on that. But the principle here is if the window's open, in this case to the downside, you can trade in the direction of the open window. Okay, well, let's see where this trade went. Let's zoom out just a little bit here. Obviously, at this particular time, it was huge because the Dow Jones Industrial Average sold off from 29,000 to only about 18,000. Yeah, it was only 10,000 points. Not a big deal. 30% in a week and a half. Not a big deal at all. All right, so let's move forward here. You're going to see another little setup. Let me zoom in on this one. There we go. This is an interesting one because we had right here a bullish gap. So there the window is open to the upside. But then just 4 trading sessions later, we open back to the downside. You see that? And so the bullish trade is off. And that's the principle of the gaps. When it opens to the upside, when the window's open to the upside, you're going to be bullish. And you're going to trade in the direction of the bullish window. So you'll be bullish, or excuse me, trade in the direction of the open window. You'll be bullish as long as the window's open to the upside. If it flips and it's open to the downside, then we're going to be bearish until it's no longer open to the downside. And that's what you see here. Now, if I zoom out just a little bit so you can really see this chart, what you'll see with this, this particular gap is, a few weeks later, it filled and you really didn't make any money. You may not have lost much, might have lost a little bit, but you didn't really make much, but didn't. Ooh, look at this one here. Okay, right here. So there's that pattern we've identified a couple times here. You see we keep running into the same pivot area is what we call that. Again, it doesn't matter if you know the pattern name or not. I'm drawing it, but it doesn't matter if you know it or not. Look here where I'm putting this big arrow. You see that? Oh, there's a bullish gap. So that is a gap to the upside. It's an open window, folks. Trade in the direction of the open window. Now, if you did that on this trade, you would have gotten into the Dow index around 29,000. And here's where we went. Ooh, what? Are you kidding? Yeah, only 6,000 points later. Yeah, there it is. Wow. The power of gaps. The power of gaps. Breakaway gaps. This is what we call a continuation gap. We also have another type of gap that we call an exhaustion gap. There's all sorts of gaps. But folks, these are 5 principles as it relates to chart patterns that if I had to teach my 11-year-old, my 9-year-old, my 6-year-old, whichever kid you pick one. If I had to teach them, just 5 or 6 things about chart patterns that I think a kid can understand, these are the things that I would teach them. And just in understanding these 5 principles, they would have an edge on the market. They would be way ahead of the average trader. So if you think it would be good for an 11-year-old, then would it be good for an adult? The answer is yeah. I mean, what you just learned here, what I just shared with you, is more than most people have whenever they approach the stock market. Whenever they come in and they start looking at a chart or they're trying to pick a trade, most people have no clue of this stuff that I just shared with you. And so they're watching CNBC, they're watching, Kramer or whoever it is, trying to get some trade picks, or they're just driving down the street and say, oh, look, there's Best Buy, or there's whatever. And I like that company, so I think I'm going to buy it. Or they're looking at the big movers for the day, and they're just kind of randomly picking stocks. And, here's the thing, you can do that. You can do it. You're just not going to make a lot of money on it because it's a lot of randomness. But when you learn to recognize patterns, or you learn to recognize, some of the other principles that I teach, it becomes so much more predictable to pick stocks that are going to make money because you've got a reason to get into it. And it's a reason above and beyond just kind of this randomness. So if you like this, you want to learn some more about it, then all you need to do is just check out what we're doing over at Trade Maestro. And if you've never been over there, it's really simple. Just visit us at trademaestro.com, where we're going to teach you a whole lot of this kind of stuff. This is just the beginning. Chart patterns are one of the many things I teach. But I tell you what, if you really want to get started, I got to find the button over here. There it is. I knew I had a button. If you really want to get started and take your trading to the next level, there it is. I love it. Join me for the Pick Winning Stocks Challenge, where we can teach you how to pick better trades, do strategy. You're going to learn how to put a trading plan together, your indicators, lower your trading risk. We're going to teach you how to make money, obviously trading. That's the idea. And you're going to learn all this in 21 days. This is the perfect place to get started trading. Go ahead and take the challenge. You can sign up over at trademaestro.com. You can take the challenge over there. Like I say, it's a 21-day challenge. And in this challenge, you're going to learn basically my entire trading system. So go ahead, check it out over at trademaestro.com. In fact, I'm going to put the link after I do this video. I'll put the link up here so that you can just click right below in the comments. All right. Hey, if you're not subscribed, do it. Subscribe, wherever you are, Facebook, YouTube, wherever you are, subscribe, like, friend, whatever you need to do so you can get notifications of all the videos that I put out. And then whenever I do another one of these, you'll get the notification. All right. Hey, thanks for joining me. I hope you've enjoyed it. I hope you've learned a lot. And if I can help you with anything, again, just check us out over at trademaestro.com. Until next time, happy trading, and we'll talk to you soon.